Hi everyone, and thank you for joining me this afternoon for this workshop titled Building the Path to Your Super. So it being a workshop, it's meant to be interactive, so I would certainly encourage you to send in any questions that you may have so I can answer those for you at the end, and also to fill in the feedback form at the conclusion because that'll help shape future presentations for you as well. You'll probably be able to see a few windows open on your screen at the moment as well. And I've got quite a few screens open here in front of me. So if you want to adjust the size of any of them, you can do that by clicking the arrows in the corner there of the window, or you can hide a window by clicking an icon at the bottom of the screen. So hopefully that's helpful for you. So with that, we'll begin. So a little bit about me. I've been working in asset management for more than 25 years, both here and overseas, more recently at BlackRock, and then prior to that at QBE. So I've joined REST in April, and it's been an absolutely wonderful opportunity to join the fantastic team that Andrew Lill has been building here. Andrew Lill being our Chief Investment Officer, and to join a fund that really has such a wide community footprint right across Australia. I think that's fairly unique for REST. So since joining, I've been incredibly busy building out my team and also using my experience to construct and position portfolios for you, our members, to achieve your personal best retirement outcome. I think the other great opportunity here at REST is that I get to help build and shape portfolios that can make real world differences. A couple of examples of that being through investments in renewables or our commitment to impact investments as well. So with that, I'll just turn to the agenda now. So three areas really to focus in on the workshop today. Firstly, some of the exciting changes that have been occurring in REST's investment team and a little bit about the uplift in our capabilities. What are some of the inputs we consider when combining different asset classes in building portfolios to achieve your best possible retirement outcome? And then finally, some of the economic and market themes that are top of mind as we look to a post-pandemic world. So turning to our capabilities. Firstly, we've been leveraging our scale. So as a large and growing fund, we're able to use our size to access a much wider range of asset classes and opportunities that are not available in traditional listed markets. So examples of that would be investments in asset classes like direct property, infrastructure, and agriculture. And we can also use our size to negotiate lower manager fees. Of course, with size comes better bargaining power. In terms of internalisation, we've been building out a very strong investment team with deep experience. We've got new team members that come from a variety of different backgrounds, and they've really enriched our insight across asset classes. And the internalisation's also given us more control over portfolio positioning as well. When it comes to technology, particularly when it's been applied to investments, technology advances have really exploded in recent years. It's been quite incredible. And we've been big adopters of new systems, new analytics, and they're providing some fantastic insights into the portfolio. They're boosting our investment decision-making capabilities, and they're allowing us to respond to market opportunities very quickly. We're also using that technology in our risk management. So our new technological tools have enhanced our risk management capabilities, and they're allowing us to manage the portfolio carefully and actively through periods of market volatility. And then finally, we have a whole portfolio approach. So for REST, it's not just about having a deep bench of quality people. It's about how we work together as a team. And our internal investment team has a singular whole of fund approach, allowing us really to come together to determine where we can express our best investment ideas across asset classes and across the portfolio. So when it comes to building your portfolio, we look at a range of factors when looking at the combination of asset classes in our investment options. So we'll look at the real return objective and time horizon. Generally, a longer time horizon will tend to have a higher allocation to growth assets like equities. and have a lower need for liquidity. So you can have more exposure to asset classes like private assets, where you can earn high returns for that illiquidity premium. We'll also examine the risks that the portfolio is running. We'll model how resilient the portfolio will be in times of market volatility. And portfolios with shorter time horizons will generally have a much lower appetite for risk and will tend to weight more towards asset classes like cash and bonds. We also look at how our peers are positioned when we're framing portfolios, because we know this is a competitive business and we're all competing to be a high-performing super fund. And at times we're also competing for similar assets. And we also know that sustainable and responsible investing is incredibly important to our members, and we've been incorporating environmental, social factors and good governance in our portfolios since 2013. So our default fund, the core strategy, and all other choice options have been structured to achieve their stated return and risk objectives, and after consideration of all of these factors. So turning to the slide titled Allocating Your Assets. So the basic tenet of investment is that if you want to achieve a higher return outcome, you must also accept a higher level of risk. So what we're showing here in this chart is a ranking of asset classes that demonstrate that particular trade-off. So asset classes like cash have a lower risk and more return certainty, but that return is lower. Now, the amount of risk an investor can take really depends upon individual circumstances, but generally, if you have a long time horizon, you can afford to take on more risk. So you're more likely to achieve your longer term financial goals by carefully investing in asset categories with greater risk. And we call these growth assets. So on this chart, you'll see the two blue circles at the top right-hand side, global shares and private equity. They have a higher risk, but they also have higher potential returns. So although they're more volatile, the longer term horizon really allows you to ride out that volatility in the market. And we saw last year just the importance of staying the course when it comes to investing in growth assets, particularly with the strong rebound that we saw last year. Now, asset allocation refers to the mix of investments in a portfolio, and that's probably the most important decision long-term investors can make, particularly the case when interest rates are near historical lows. So for options such as our core strategy, a majority of the portfolio will be in growth assets. But when we construct that portfolio, we want that portfolio to exhibit resilience through periods of market volatility. So when we see that volatility, we want to include assets that perform well when growth assets like global shares go down. So typically, these would include assets like cash and bonds, and it gives more stability to the overall portfolio. But we also need to watch how those assets interrelate, because in different regimes, and we've seen this through history, shows us that there's times when both bonds and shares can fall in value, and we call that correlation. We also include in the mix asset classes like property and infrastructure. They exhibit characteristics of both shares and bonds, so capital growth and income. And they can also provide great inflation protection as well. A great example of an asset class that provides inflation protection, and it also offers an uncorrelated return stream, so it's completely unrelated to traditional listed asset classes, is our investment in agriculture with Warakiri. So my role is to ensure there's an appropriate mix of these assets, of these asset classes in portfolios to meet the investment risk and return objectives over the investment horizon, to ensure that the portfolio is resilient through periods of market volatility, and to have enough flexibility in the portfolio to respond to market opportunities. Just turning to the next slide. So when we construct an asset allocation for portfolios, we perform a lot of quantitative modelling, and we look at different combinations of asset classes during that modelling. But we also undertake extensive scenario analysis. So while quantitative analysis can identify optimal combinations of asset classes, scenario analysis can quickly highlight where portfolios have strengths and weaknesses in different events like an inflation shock or a financial crisis. So it's a very useful tool when building portfolios. Now, one of the scenarios we've run on the portfolios is on climate risk. And one of the interesting outputs that I'll just highlight here that came from our analysis is an estimate that our members will be better off if we keep global temperature increases below 2% by 2100. So climate risk, obviously, for us is very important when we're constructing member portfolios. And we've seen that through our scenario analysis. So over the longer term, we have a look at some more structural themes when we're considering the opportunity set for the portfolio. So we know over the longer term that there's demographic shifts that are happening across the globe. We know there's aging populations in Western economies, so that means there's potentially slower economic growth rates in the decades to come. We know there's more favourable demographics in emerging market economies that have younger and growing populations, so they're likely to have faster economic growth rates. And on top of this, in these particular economies, you have growing middle classes, and you're also seeing these economies move up the value chain, so moving away from areas like agricultural to more service-based economies. So we think that the coming decades will see a transferring of economic power from the west to the east, and forecasts that we see have China and India at about 35% of global GDP by 2050. So obviously a big opportunity to look at those geographical areas as we shape the portfolio for the future. We also note there's rapid pace of technological change going on. So that's creating opportunities in areas like digitization and automation, but it also creates risk for established companies as well if they don't adapt to these new changes. There's a growing concentration of asset ownership in Australia, and increasingly because of that, we're seeing domestic investors look offshore for investment opportunities. And of course, climate risk for portfolios is a systemic risk that can impact almost everything from physical risk due to weather events right through to the cost of capital for companies. Now, when we look at how we access these opportunities, how we mitigate risk, we're looking in the portfolio for geographical diversification, sector diversification. We're looking at smarter ways of accessing these opportunities. It may be through private assets. It might be through targeted listed assets. And, you know, we would note that some of these listed markets in emerging markets don't really reflect the underlying economy. So sometimes private assets might be a better path to access some of those opportunities. And we're also making sure our portfolios incorporate sustainability and climate integration as a way of delivering better risk-adjusted returns for the portfolio. Over the medium term, the global economic outlook and policy settings are generally favourable. Central banks have kept interest rates at quite low levels. And while economic growth appears to have peaked in the near term, it's going to probably remain at relative high levels to where it's been in recent years. And this should continue to support corporate earnings generally. But some of the potential headwinds that we're looking at include recent developments in inflation. We're watching some of the changing geopolitical dynamics as well. It's a much more competitive world now. There's different supply lines out there. We know there's different growth rates across economies and different sectors, so recovery certainly won't be in a straight line. And we think markets are going to be very sensitive to changes in some of the strong policy settings that we've seen in recent years, particularly at a time when valuations are very high across many asset classes. So we would expect some setbacks to come. But generally, the outlook with the global economy still expanding and policy settings quite favourable sees us with a modest bias to growth assets in the portfolio for the time being. Touching on inflation now and growth. So here is a chart just of the progress on vaccination. So Australia and the world's made some great progress on vaccination levels. So we think this supports an ongoing expansion of global growth as economies continue to open up. And we're seeing a lot of pent-up demand for goods and services, for example, like travel. And unlike previous financial crises, we have both policy arms of the central bank and government policy working together. So that's certainly helping to supercharge the opening up of economies. But what's happened as a result of that is as economies have opened up, that's met with supply bottlenecks in both goods and labour markets. Supplies of goods in particular have been constrained because during the pandemic, factories really couldn't operate at full capacity. And so this is seeing some very strong increases in prices at the moment across the globe. So we're seeing decade high levels of inflation in Europe and multi-decade highs in the US. So this is a large topic of debate at the moment on whether these price rises will be transitory. Particularly as supply increases to meet demand, we might see some of that dissipate. But there's certainly a big debate going on whether some of these price increases become a more permanent part of people's expectations, and that where it becomes more problematic. So just looking at near-term considerations, I'll just reiterate that we're positive about economic growth prospects, but there are things that could see volatility re-emerge in the short term. A couple of key things that we're watching are policy measures. Although they're supportive for the moment, markets are going to be very sensitive as to how governments and central banks start to normalise policy settings, because they are at pretty extraordinary levels. And we also obviously need to watch inflation outcomes, because that's something that hasn't been factored into markets for some time. Diversification, as always, is key, both across the portfolio and within asset classes. And if we look at individual asset classes, we think equities generally remain supported. We're wary about the impact of higher interest rates on fixed income assets, because there's an inverse relationship between yield and price when it comes to fixed income assets. We think unlisted property and infrastructure assets provide great diversification for the portfolio should inflation prove to be more persistent. And they also provide fantastic areas of new opportunities for investment. So an example of this for us has been a recently acquired stake in Copenhagen Infrastructure Partners. Now, they're one of the largest funds globally focusing in on renewables. And we've also added to private equity in the past year, and believe this is a natural area going forward to take advantage of new technologies and innovative companies. So finally, just some key points to leave you with. Our focus is very much on achieving your personal best retirement outcome, and the capabilities that we've built and provide a great platform, I think, for achieving that. I've highlighted some of the opportunities and risks, both short-term and longer-term, that we take into account in achieving competitive returns and building resilient portfolios. And to secure those competitive returns, it's incredibly important to have a disciplined investment process by building diversified portfolios, ensuring that the risks are well understood within the portfolio, and also being responsive to opportunities as they arise. And finally, if there's one thing I could leave you with, it was that last year was a great example of staying the course. So having a long-term investment horizon when it comes to retirement leads to much better investment outcomes. So with that, I'll thank you for listening, and I'll now take look at some of the questions that have come through. If I can't get to all of them in the allotted time, I'm just conscious I've just run a little bit over, our team will definitely get answers back to you in the following days. So let me just have a look at some of the Q&A that has come through. So a question from Angie. The question is, you mentioned China and India. What sort of investments would we see with India? So at the moment, our exposure to India is largely through our listed international equities. We do have a slight overweight in our exposure to India in the portfolio. It's a fairly small part of the global listed equity market, but we do have a slight overweight there. So we're accessing India through listed equities. Now, a question here from Ian. Has REST direct property investments been affected by COVID, and what is expected next? No, we haven't seen any detrimental effects from COVID for our property investments as yet. We certainly haven't seen any sort of revaluations on that. But I'll just highlight that our direct property investments are extremely high quality. They're high quality, long duration assets. They're in premium locations, and the office properties are very well leased. They have a weighted average lease life of over 8 years with quality tenants. And we're certainly seeing a lot of people now come back to the city in response to the opening up of economy. So at the moment, we haven't seen that impact as a result of COVID. Now, question here from Jun Liang. So sorry if I've mispronounced that. What is REST's take on cryptocurrency market? So that's a fantastic question, and it's a question that we get asked quite a bit. So at the moment, crypto really doesn't pass our screens and our high quality screens or criteria for investment in the overall portfolio. It's something that we're watching closely and carefully. We certainly want to see how this market unfolds. I would say, for the moment, for us, it's a little bit hard to determine, the intrinsic value within that investment. There's a lot of opaqueness surrounding it, particularly with a lack of regulation, and hence there's a lot of volatility around it. But we're certainly watching on to see the role that the cryptocurrency market plays in the future. Another great question here from Zinlang again. Thank you very much for that. So how would REST investment strategies change in accordance to potential interest rates? So at the moment, we think that interest rates markets start to normalise as economies open up, as policy settings change from central banks. The way we would manage that is through duration within the portfolio. So we manage duration carefully in response to potential changes in interest rates. If you strongly believe that interest rates are going to increase by a meaningful amount, generally you'll run strategies in the portfolio that have a shorter duration. So within fixed income, for example, we would have a tilt within the portfolio at the moment that is shorter duration, and that allows us to firstly offset any sort of capital losses as interest rate rise, but it also gives us the opportunity to lengthen up the portfolio as interest rates rise, and we can take advantage of those high yields as they come through. And another great question here from Angie. Are you doing anything different with investment than our competitors? Yeah, that's a great question. Look, I think we're different in that we're acutely aware of our membership base. Look, we know they represent a large cross section of society. They live in communities across Australia. We've listened to them, and we've built solutions based on their feedback. So our sustainable growth option is a fantastic example of that. We're also acutely aware that we're investing in assets that are part of their local communities as well. So some of the investments that we have in wind farms, in agriculture, they're investments, they're not only providing a great return to the portfolio, providing great diversification, but they're also sustaining local communities as well. And they also have positive environmental outcomes as well. So I think that's where we're very different from our competitors. We've also embraced technology heavily, as I've mentioned at the start. We're also using our capabilities in terms of our private markets asset selection. We've got a long-established private markets team, particularly in infrastructure and property, and they've earned some great returns over the years. So I think these are the areas where REST is very different from our peers. A question here from Kathleen: why the lower investment into agriculture? So we have a small exposure to Australian agriculture. So that's part and parcel of the portfolio. We're still looking at further opportunities, but what agriculture does for the portfolio, it gives great inflation protection for the portfolio. It provides great diversification as well. And it also meets our ESG objectives as well. So it's broadacre crop that we're exposed to, and it's all rain-fed as well. So that's an area that we continue to look at for opportunities going forward. So here a question from John: if your allocation was currently 100% cash, would you move to a higher growth risk allocation now, or hold off pending quantitative easing or interest rates rising? Thanks, John, for that particular question. Look, we certainly wouldn't have 100% cash weighting in the portfolio, because that's not going to meet real return objectives. Look, in the portfolio at the moment, I would say we have a bias to growth assets within the portfolio. This process of normalisation, so far it's been digested pretty well by financial markets. So even though there's a headwind from interest rates, really it's in response to a growing global economy. And when you get a growing global economy, you're getting growing earnings. And the evidence to date is that despite some inflationary pressures, that corporates have been able to pass on some of those price increases to the consumers at the end of the day. So we don't tend to take big timing bets across the portfolio. We're looking for very discrete, concentrated bets within asset classes as a way of outperforming benchmarks. But I would say that we have a small bias towards growth assets in the portfolio. So I think that comes to about the end of the questions that I've received here. I'm just having a look at a few more. Can you provide an example of what a private asset is? So typically a private asset is an asset that you can't access on a listed market like shares, where you can just ring up a broker and buy that. They're generally an asset class like infrastructure or direct property or private equity, where you need size to access the opportunities that are available in those segments. Private assets also don't mark to market on a daily basis like you would see on a listed exchange. So again, that provides a little bit more stability to the portfolio as well. So with that, I'd like to thank everyone for some of the fantastic questions that have come through. Hopefully, everyone's taken away something, and I've been able to give a little bit of insight into how we think about putting portfolios together. As I said at the start, if I haven't got to your question today, the team will definitely come back with an answer in the coming days. So with that, thanks everyone for your time today. It's been fantastic being able to talk to you a little bit about REST and what we've been doing in terms of achieving some of the great results more recently for you, and in terms of building out the portfolio. So thank you very much for your time today.